the fact that the gold price really needs to take a bit of a lift here, or there are going to be some cutbacks in production. Some of the higher cost mines just aren't going to, unless we see a sustained lift in prices into the more like the $2,000, $2,100 range, I would guess that we'll see some production cutbacks.
Out of one particular, you've got these natural hedging abilities. And I think what's also interesting, because now I'm a firm believer. Yes, you've said also that gold and silver are undervalued, tremendously undervalued. And I think one of the important things that we're focusing on big time is the advent of Basel III legislation, making the over-the-counter market in London, or the over-the-counter markets, actually forcing them to be NSFR compliant. So whereas up until January, 100 to 1, you could play with it, you could just settle gold credit debit positions and play that game. All of a sudden, and people haven't realized this yet, but all of a sudden we're seeing the Bank of International Settlements, the central bank of central banks, actually unloading their leases and swaps. And why are they doing that? Because they're themselves becoming Basel III compliant. And so what that's telling us is that a real supply-demand price that we have not seen since Nixon closed the gold window, what it's done is essentially quietly opened up the gold window, because now I can EFP a COMEX position, I can put it into the over-the-counter market and force T+2 delivery. Okay, I've got to pay a premium, but I can do it. And I think so. I think what I'm really leading to is, I see, and we all think, oh, what is the real? We talk to our liquidity providers globally. We've got vaults all over the world. We talk. What's the general consensus? Where do you think the realistic price for gold should be? And the average is around $3,000. I guess my question to you is, what is your break-even price? Average break-even price to produce gold, and what would $3,000 an ounce do to your share price?
Well, I think obviously it would provide a big lift. People would get very excited. But the realities of prices, about a year and a half ago, a friend of mine was talking about putting together, kind of a sophisticated, let's say, financial instrument in the form of a hedge fund, effectively, and wanted to know more about gold. So I did quite a bit of an in-depth study of what operating costs are, cash costs of production in North America, and then full cost, meaning cost plus sustaining cost. And so the average numbers, and this is amongst the majors and some of the mid-level producers and stuff at that time, was around a $1,050 to $1,100 cash cost, and around sort of $1,300 of just full in costs. So when you have a $1,700, $1,800 gold price, it's a $300, $400 delta. If you've got depending on your own cap structure and your cost of capital, it's reasonable, but it's pretty thin. And with recent inflation and supply shortages and so on and so forth, it'll be interesting to see what the numbers are coming out, in terms of cash costs of production of this year. See what's been impacted, and I've got to believe that things are trending quite a bit higher. That that 1050 is now closer to 1150 to 1200, and that all-in sustaining costs are something around 14. And so you are starting to close in on that the fact that the gold price really needs to take a bit of a lift here, or there are going to be some cutbacks in production. Some of the higher cost mines just aren't going to, unless we see a sustained lift in prices into the more like the $2,000, $2,100 range, I would guess that we'll see some production cutbacks, and that just exasperates what I do think there's a shortage of gold around the world. I'm quite sure you have a better handle on it than me in terms of actual numbers. But from the operating viewpoint, it's a pretty tight situation on the operating level, I would believe, particularly now with the the recent supply shortages and price increases on goods, and there's so many prices on things. This is an interesting talk when you think about inflation, because inflation is as much a mindset as anything, right? Um, and fully 70% of what they publish as the inflation index consists of what they call sticky prices, not flexible prices. So when you think about it, if you're a supplier to the mining industry, for a long time, you're going to wait before you decide to start bumping prices, because you don't want to lose customers. You want to see, are these prices, these supply shortages, a short-term thing, or I can live with for a couple months, or is this something that is more permanent, and then I need to boost prices? But once you get into the boosting prices mode, okay, and you've hiked your prices, and your customers have said, yeah, okay, part of the inflation story, well, you're very reluctant to lower that price again until you see major inventory build, right, and lack of demand. And so once the mindset becomes more like a rising price mindset, other than things like, say, gasoline or things that move, are fairly flexible, react quickly, but these durable goods and equipment and things like that, those prices are not going to adjust nearly as rapidly. And people's mindset in terms of where prices are going to be, they're going to have to see a lot of evidence of a softening demand and softening prices before they decide to lower their prices again to their customers. That's just how I see it, but I think that's pretty well known in terms of the economics world, and just common sense would tell you that's how people operate,
Yeah, absolutely. I mean, that makes a great deal of sense. So, given what we're experiencing now, we had a black swan event essentially with Russia and Ukraine. Very close to a black swan event, or who knows how that's going to play out after Pelosi went to Taiwan. I mean, there are things that we see from our perspective. We're seeing physical buying. People who are moving in, a lot of our Asian clients, European clients, are buying a lot of physical. We are seeing, with reference to the Russia trade, we're seeing Indian buyers buying gold, taking a 30% discount on the oil by providing that gold to Russia, and then selling that gold back on the market. It's a very, very, my goodness me, that's a profitable arbitrage trade. And it is, we've seen smuggling, and World Gold Council figures probably 30 tons a month smuggled into India. We think that's almost tripled at this point, because it's a no-brainer trade. But nobody is measuring this suck on supply. And I think what we're seeing here is really a build for a very, very large short squeeze on the paper market. And I think really, when I start to think of silver, and we looked at what happened with nickel, which was basically simply a non-Basel III, obviously, over-the-counter market, which had gone way in excess of where it had been ultimately betting against the rise in price. Now, while silver, and we're seeing all of these things, and of course, silver's joined at the hip with gold, and we're seeing all of these things that are screaming at us. This is underpriced. This is grossly underpriced. No one's really, the paper market has acted like a flywheel, suppressing the price. But as we say, that EFP mechanism is now sucking out the physical, and it's going to our clients and everyone. We know of sovereigns, we know of first-tier banks loading up physical. So I think we're very, very close to seeing a silver enter a nickel-like default, unless something is done, unless the prices allow us to rise. And I think whereas the LME can control, I'm sure you're familiar with the LME and how it operates, but they were able to ring fence that, settled it, no problem at all. But silver's a foreign exchange cross. It is your long silver, short the dollar, long dollar, short silver. So basically, you cannot ring fence it. It is a deliverable product. And so it's going to be interesting. What What are your thoughts around that? Do you think silver could go nickel at some point?
Well, I guess the comparison would go back to what happened with the hunts, and of course they had several the sheikhs from Saudi Arabia on their side too, I believe. So they have a tremendous amount of capital, and they're buying into a very limited market. And the example there, I think, when they crushed the hunts by changing the rules, you probably know it better than I do, but as I understand it, they changed the rules by basically saying that you couldn't buy a long position unless there was an offsetting short position.